Morning everyone. Myself Naina Tyagi, Assistant Professor of IIMT College of Management. Today I am going to speak about dividend decision and policies, how the dividend decision of the firm impact its market price of the shares. So in today's session, I am going to explain about what the dividend concept is, how dividend decision impact the valuation of the firm, and what are the relevance theory of dividend policies and what are irrelevance of dividend policies, and after that dividend policy determinants and types of dividend policies. So before going further, we should be familiar with the term what the dividend is. Dividend refers to that amount of profit after tax which the company earns and which distributed among the owners and shareholders of the firm. In dividend decision, financial manager is concerned to decide one or more the following. Should the profit be retained back to finance the investment decision, or whether any dividend should be paid? If paid, then how much dividend should be paid? When these dividends should be paid, it could be interim dividend or final dividend. Interim dividend is that dividend which the company distributes to its shareholders in between the financial year of the company. In what form should the dividend be paid? It could be cash dividend or bonus shares. Bonus shares here means the shares issued free of cost to the existing shareholders on the basis of pro rata. All these decisions are interrelated and have bearing on the growth plans of the firm. Here we will explain what is a dividend policy. Dividend policy is basically determining what dividend should be paid and in what amount it should be paid. It could be interim, final, cash dividend or bonus shares. So here dividend policy means basically concerned with deciding whether to pay dividend in cash now or to pay increased dividends at a later stage, or distribution of profits in the form of bonus shares. The basic question here arises to be resolved while framing the dividend policy is what is the rationale for dividing dividend payments? Given the firm's investment and financing decision, what is the effect of the firm's dividend policies on the share price? How it impacts the share price of the firm? It could be negative impact or positive impact. Does a high dividend payment decreases, increases, or does not affect the share price? Here we are explaining the relevance, irrelevance theory of the dividend policies. Different models have been proposed to evaluate the dividend policy decision in relation to value of the firm. Here are basically three main models, or we can say that there are three main dividend theories which we are going to explain. These are dividend relevance theories, those theories which states that the dividend policies of the firm do impact the market price of the shares. It could be negative or positive impact. And after that, dividend irrelevance theories. Theorists of these theories explains or argue that the dividend policies do not impact the market price of the share. Actually, the investment decision and policies plays a major role in deciding the market price of the shares. And after that, the relevance of dividend and uncertainty. Dividend relevance theories. These are the theories whose propagators argue that the dividend policy of the firm affects the value of the firm. There are two main theorists, James E. Walter and Myron Gordon. So first of all, we will going to explain or learn about the Walter's model, which is given by James E. Walter. It shows relationship between rate of return and cost of capital. So before going further, we should be familiar with the term what the rate of return is and how the cost of capital is computed. Rate of return is if the company invests its surplus funds or its retained earnings in different projects, it expects some sort of return over their investment. So here we are calling that return on the investment rate of return, and cost of capital is the cost which the company incur in the issue of the capital. It is based on the following assumption. In Walter's model, the basic assumption of this model is that all the projects are financed internally There is no need to raise funds externally. So the firm finance all its investment through retained earnings. So there is no scope for debt or new equity. There is constant return and cost of capital, 100% payout or retention. There are two cases. All the earnings are either distributed as dividends or reinvested internally immediately. Constant EPS and DPS. Here EPS means earning per share and the DPS is dividend per share, which the company distribute to its each equity shareholder. Beginning earnings and dividends never change. The value of the EPS and DPS may be changed in the model of determined results, but are assumed to remain unchanged in determining a given value. The company is having very a long life or a infinite life. The business risk complexion of the firm remains the same. So if we explain about Walter's model, so it shows the relationship between cost of capital and rate of return on the basis of which dividend policies of the firm has been decided and the value of the firm is determined. Dividend policy affects the value of the firm. Together, the cost of capital and rate of return determine the dividend policy that will maximize the shareholders' wealth. Here is the formula of the Walters model, which helps us to determine the price of the share, or we can say the fair value of the share. It is determined by dividing DPS by K plus R, EPS minus DPS divided by K and whole divided by K. Here P stands for the market price per share or prevailing market price of the company. Dividend per share, EPS is earning per share, R is firm's average rate of return and K is the firm's cost of capital. The market value is determined as the present value of the two sources of income. Present value of constant stream of dividend, which is computed by dividing DPS by K. Present value of infinite stream of capital gains, EPS minus DPS divided by K multiplied by R. The financial management or dividend decision can't be completed without the concept of time value of money. For that purpose, we have computed present value of constant stream of dividend and infinite stream of capital gains. In Walter's model, or as per the Walter, there are basically three types of firms prevailing in the market. It could be growth firm, declining firm, or a normal firm. Here, growth firm means there are several investment opportunities. That means the rate of return is more than the cost of capital, and the firm can reinvest earnings at a higher rate than that which is expected by the shareholders. Thus, they will maximize value per share if they reinvest all the earnings. Hence, dividend payout ratio is 0 for the growth firms and all profits are retained. Next, normal firm. There aren't any investments available for the firm that are yielding high rate of return. So thus the dividend policy has no effect on the market's price. Here's average rate of return is equals to the cost of capital. Declining firm. There aren't any profitable investments for the firm to reinvest its earnings. That is, investment would earn the firm a rate less than its cost of capital. So the firm will therefore maximize its value per share if it pays out all its earning as dividend. Hence, payout ratio is 100%. All the profits are distributed as dividends. The main criticism of Walter's model is that it assumes that all the projects are financed internally, but in real life, it can't be happen. It is totally illogical. Model assumes investment decisions of the firm are financed by retained earnings only. This model assumes a constant rate of return, as we know that the market is fluctuating and flexible in nature. So because of that, the rate of return can't be constant. The constant cost of capital, this disregards the firm's risk will change over the time. Hence, the discount rate will change over time in a proportion. Here is the example. how the rate of return and cost of capital impact the market price of the share. Now we will go further. We will explain the next model of dividend relevance theory. The assumptions of Gordon models is some sort of similar of the Walters model. The firm is an all equity firm. That means there is no scope for debt. No external financing is available. Again, the whole projects of the company are financed by retained earnings. So consequently, retained earnings would be used to finance any expansion of the firm. Similar arguments as Walters for the dividend and investment policies. Constant return, which ignores diminishing marginal efficiency of the investment as represented in the diagram on Walters model. There is also constant cost of capital. It ignores risk effect of the, as we did in the Walters model. There is perpetual stream of earnings for the firm. Corporate taxes do not exist. Constant retention ratio, that is one decided upon stays as such forever. The growth rate equals to G, that is computed by multiplied by B into R. B here stands for the payout ratio. Cost of capital is greater than the growth rate. Otherwise, it is not possible to obtain a meaningful value of the share, because if the cost of capital is less than growth rate, then the market price, or we can say the value of the share, will come to negative, or which is not possible in practical life. According to Gordon's model, dividend per share is expected to grow when earnings are retained. The dividend per share is equals to the payout multiplied by earning. To determine the value of the firm before based on dividend growth model, the value of the firm will be EPS multiplied by 1 minus B. So here we can say that we are dividing dividend by K minus G. Here dividend will equals to EPS 1 minus B, because in this case we are deducting the dividend payout, the amount which we retained ourselves, by EPS, and dividing the cost of capital minus G. Here 1 minus B is the retention ratio. That means the proportion which we are going to retain by ourselves. G is the growth rate and it is always less than K. Or we can also write this formula as P0 equals to D1 divided by K minus G. So D1 is the current year's dividend and P0 is the base price. So if we are given with the D0, that means previous year's dividend, then we'll have to adjust it with the growth rate. That will be D1 will be equals to D0 multiplied by 1 plus G. The conclusion of the Gordon's model are similar to Walters' model due to the fact their sets of assumptions are similar. The market value of P0 increases with the retention ratio. As much as we are retaining our earnings, the P0 will increases for the firms with the growth opportunities, where rate of return is more than the cost of capital. The market value of the share increases with the payout ratio for declining firm. The more we pay to our shareholders, the more our price going to be increased. The market value is not affected by the dividend policy when the rate of return is equals to the cost of capital. Now, the last theory is the bird in the hand theory. That means we value the dividend in hand now as the dividend will receive in the later stage. Relaxing of the Gordon's simplifying assumptions to conform slightly to reality, he concludes that even when rate of return equals to cost of capital, the dividend policy does affect the value of the share. Based on the view that under condition of uncertainty, investors tend to discount distant dividends at a higher rate than they discount near dividends. As we know that the future is uncertain. Although the rate of return is equal to the cost of cost of capital. Still, the investor wants dividend in hand now because they know future is uncertain. There may be the chances the company may be involved in some scams, or there may be the chances their depression will come, or there will be recession. So the investors demand dividend now. The investor behave rationally, are risk averse, and therefore have a preference for near dividends to future dividends. Put forth by the Krishman in the following terms of two stocks with identical earnings record and prospects, but the one paying higher dividend than the other. The former will undoubtedly command a higher dividend than the latter, merely because stockholders prefer present to future values. Stockholders normally act on the premise that bird in the hand is worth two in the bush, and for this reason are willing to pay a premium price for the stock with the higher dividend rate, just as they discount the one with the lower rate. If we are talking about the practical life, yes, dividend policy do impact the market price of the share, because as a common man, if we think about ourselves, we are going to invest in a particular company. We want some return over there. That's why we are investing our money in their company. As well as we also want some sort of capital appreciation. Uncertainty of dividends increase with the futurity. That is, the further one looks, the more uncertain dividends become. When dividend is considered with respect to uncertainty, the discount rate cannot be held constant. It increases with uncertainty. Investors prefer to avoid uncertainty and would be willing to pay a higher price for the share that pays the higher current dividend, all things held constant. The appropriate discount rate would thus increase with the retention ratio. Relevance theory of dividend policy. These theorists argues that the dividend policy do not impact the market price of the shares, and actually the investment decision and policies do impact. The other school of thoughts on the dividend policy and valuation of the firm argues that what a firm pays as a dividend to shareholders is irrelevant, and the shareholders are different about receiving current dividends or receiving capital gains in future. There are basically two models for the same: residual theory of dividends and Modigliani and Miller approach. As per the residual theory of dividend policy, it holds that the firm will pay only dividend from residual earnings. That means the firm first of all will invest its surplus funds in further projects, and if after investing in further projects the company retains some earnings, then only the company will distribute dividend to its shareholders. That is, dividend should be paid only if funds remains after the optimum level of capital expenditure is incurred. That is, all suitable investment opportunities have been financed. With the residual dividend policy, the primary focus of the firm is on investments, and hence dividend policy is a passive decision variable. The value of the firm is direct function of its investment decision, thus making dividend policy irrelevant. Thus, a firm does not decide as to how much dividend be paid. Rather, it decides as to how much profit should be retained so that the company could invest in further projects and earn extra returns over their projects. The profits not required to be retained may be distributed as dividends. Dividends irrelevance. The propagator of this school of thought were Franz Modigliani and Merton Miller. This approach is also known as model or irrelevance theory. According to Modigliani and Miller, under a perfect market condition, the dividend policy of the company is irrelevant and it does not affect the value of the firm. Under conditions of perfect market, we know that the investors are rational. There is absence of tax discrimination between dividend income and capital appreciation. Here, capital appreciation means the difference between the current prevailing price and the price at which the shares have been acquired. Given the firm's investment policy, its dividend policy may have no influence on the market price of the shares. They state that the dividend policy employed by a firm does not affect the value of the firm. They argue that the value of the firm is dependent on the firm's earnings, which results from its investment policy, such that when the policy is given, the dividend policy is of no consequence. Condition that face a firm operating in perfect capital market, either the firm is having sufficient funds to pay its dividends, or there may be the chances firm does not have sufficient funds to pay dividends. Therefore, it issues in order to finance payments of dividends. So the major difference between theory and dividend relevance theory is that their external financing do exist. The firms does not pay dividends, but the shareholders need cash. Assumptions of hypothesis. Perfect capital market, that means all the investors behave rationally, but actual life, this is not the case. Information is freely available to all the investors, but we know that in practical life, insider trading do exist. So all the information is not freely available to all the investors. Transaction and flotation costs do not exist. But in actual life, there may be transaction cost too. No investor is large enough to influence the price of the share. The taxes do not exist, or there is no difference in the tax rates applicable to both dividends and capital gains. The firm has a fixed investment policy. The risk of uncertainty does not exist. That is, all investors are able to forecast future prices and dividends with the certainty, and one discount rate is appropriate for all the securities over all the time periods. But we know that future is totally uncertain. We can't predict future. We can see this in this pandemic era. We are not aware that the COVID will come. So in actual life too, we can't predict the future prices of the shares. So the risk of uncertainty does not exist is a drawback of this model. Under the assumption that the rate of return will be equal to the discount rate, as a result, the price of each share must adjust so that the rate of return, which is composed of the rate of dividends and capital gains on every share, will be equals to the discount rate and be identical for all the shares. The return is computed as follows: dividends plus capital gain or capital loss divided by share price. Here capital gain means difference between the current market price and the previous year's market price, or we can say the selling price minus the purchasing price. Conclusion of this model is a firm which pays dividend will have to raise funds externally in order to finance its investment plans. When a firm pays dividend, therefore, its advantage is offset by external financing. This means that the terminal value of the share declines when dividends are paid. Here, terminal value means the selling price or current prevailing market price or the maturity price of the share, thus the wealth of the shareholders, dividends plus the terminal share price. So here wealth means the periodical return which the shareholders is getting from the company plus the current prevailing market price is the wealth of the shareholder. Consequently, the present value per share after dividends in external financing is equals to the present value per share before the payments of the dividend. Thus, the shareholders are indifferent between the payments of the dividends and retention of the earnings. If we conclude in this session, we can conclude that we know dividends do impact the market price of the share. Just take an example. If we are going to invest in a particular company, we want something in return for that. And also we want capital appreciation too. So in real life, the mixture of both the models, that means both the theories, relevance as well as irrelevance theories, do exist in some mixture types of things. So If we are going to invest in a company, we want periodical returns, as well as its current market price should be higher as compared to the previous year. We are interested in its trend analysis, how the company is growing, how the company is paying dividend. If the company is regular in paying dividend to the shareholders, then we only invest our money in a company. So this is my presentation. So I hope with this today's session, we become familiar with the term of the dividend. We came to know how the company decides its dividend policies and how do they impact the market price of that particular company. Thank you.